They wanted a quiet end to the year. That was the plan. Banks wanted to close their books. Traders wanted to log off early, and most people assumed the silver market would stay exactly where it had been. December is supposed to be slow. Liquidity dries up, desks empty out. Nothing important is meant to happen, but that's not what happened. Because on December 23rd, 2025, silver crossed a level it was never supposed to cross quietly. It didn't just touch $70 an ounce. It broke above it, held above it, and forced the entire market to confront a reality it had been avoiding for years. Silver is now trading above $70 an ounce. That alone is historic. But what makes this moment dangerous isn't the price itself. It's the contradiction behind it. On one side, silver is trading at levels not seen in more than 4 decades. On the other side, we are told inventories are strong. More than 500 million only registered silver matters. Registered silver is the metal that can actually be delivered when contract holders demand physical metal. And that pile has been shrinking at an alarming pace. In early December, something changed. Traders stopped accepting cash settlements. They demanded physical delivery instead. In just 4 days, nearly 48 million ounces of registered silver were removed from the system. That consumed roughly 60% of all deliverable silver almost overnight. That is not speculation. That is not noise. That is a structural event. This is what a loss of trust looks like. And fear always shows up before price. You can see it clearly in the EFP spreads. Traders began paying massive premiums just to escape paper exposure and secure real metal. Not a few cents. In some cases, nearly a full dollar per ounce. No rational actor pays that unless they believe the paper promise may fail. This didn't happen by accident. It was inevitable. For years, and instead of slowing down, demand accelerated. Solar energy now consumes nearly 1/3 of all industrial silver demand. Every solar panel requires silver paste. There is no substitute, no workaround, no technology that removes silver from the equation. Electric vehicles added another wave. EVs require significantly more silver than traditional gasoline cars. Motors, power electronics, charging infrastructure, all of it depends on silver. And now artificial intelligence has entered the equation. Data centers, servers, high conductivity systems. Silver is no longer optional. It is infrastructure. The problem is that supply cannot respond. Roughly 70% of silver is mined as a byproduct of other metals like copper, lead, and zinc. You cannot simply decide to mine more silver. New projects take years, sometimes a decade. So the paper market tried to bridge reality with leverage and promises. That works until physical lease rates have exploded from under 1% into double digits. That is not normal pricing behavior. That is scarcity. This is where control starts to weaken. And when control weakens, silver does not move slowly. It snaps. That's why $70 mattered. It wasn't just a number. It was a psychological ceiling, a control point. Once it broke, the market immediately started looking higher. $80 is not far away in a market that can move 5% in a single day. From there, panic accelerates. Industrial buyers do not care about charts or technical levels. If you are a CFO who budgeted silver at $50 and now sees $72, you act. You secure supply at almost any price. That's how 80 to 85 becomes realistic. Not because of speculation, but because of necessity. If exchanges ever force cash settlement because metal is unavailable, confidence in the paper market collapses instantly. That is when prices reprice violently. That is how $100 enters the conversation. Longer term, when years of deficits finally surface honestly, silver moves toward levels that once seemed unthinkable. Not overnight, not in a straight line, but structurally. This does not mean silver will only go up. Volatility will increase. Pullbacks will happen. Narratives will grow louder as people try to explain away what they don't want to accept. And this does not mean the system collapses tomorrow. What it does mean is far more important. It means paper control is weakening. It means physical demand is overwhelming leverage. And it means trust is thinning. Not broken yet, but thinning. Silver is not predicting the future. It is revealing the present. Historically, the earliest warnings are always ignored. Not because they are wrong, but because they are inconvenient. They challenge comfortable narratives before consensus forms. By the time silver's message becomes obvious to everyone, the adjustment is already underway. This is not financial advice. This is not a call to action. It is a signal. And in financial history, signals matter most before the headlines catch up.